On January 29th, gold crashed $600 in 28 minutes, the biggest single-day drop since 1983. Everybody said, "See, I told you it was a bubble." 2 weeks later, gold was back above $5,000. So here's the question nobody can answer honestly. Should you wait for the real crash, or is waiting the most expensive mistake you'll ever make? I pulled 50 years of crash data to find out.
Welcome back to another Straight Talking episode. I'm the Diversify Guy. I've been calling it like I see it for years now. While traditional finance advice remains largely unchanged, I'm showing information about alternative investment options that you might not know exist. Remember, do your own research. I'm not a financial advisor, just an enthusiast, so always consult with a financial professional before making investment decisions.
Today we're answering the question I get more than any other. Should I wait for gold to crash before I buy? To answer this properly, I went through every single major gold crash in history. I looked at what caused them, how severe they were, how long recovery took, and most importantly, what the people who waited actually lost in opportunity cost. By the end of this video, you'll know exactly how often gold crashes actually happen, the specific warning signs that preceded every major decline, whether today's market looks anything like 1980 or 2011, and the framework I'd use to make this decision. Let's go. Before we get into history, let's talk about what just happened, because this is fresh and it's exactly what crash waiters point to. January 29th, 2026, gold is sitting at $5,594, all-time record. Then Trump nominates Kevin Warsh as the next Fed chair. Warsh is a known inflation hawk. Markets interpret this as higher rates for longer. Same day, the CMA raises margin requirements on gold futures from 6% to 8%. What follows is chaos. Gold drops $380 in 28 minutes. Silver crashes 36% in the same session. By February 2nd, gold bottoms near $4,400. That's a 21% decline from the peak. Classic crash, right? Game over. Not exactly. Within 2 weeks, gold recovered to $5,050. As I'm recording this, it's sitting right there. Every major bank reaffirmed or raised their price targets after the crash. UBS called it a positioning reset, not a fundamental breakdown. This is important because it shows you what most gold corrections actually are: fast, violent, and temporary. The people who panic sold at 4,400 locked in a 21% loss. The people who bought at 4,400 are up 15% in 2 weeks. Keep this pattern in mind as we go through history. There have only been 3 genuine cycle-ending gold crashes in modern history. Let me walk you through each one. Crash number 1, 1980 to 1999. This is the nightmare scenario. Gold peaked at $850 in January 1980. Iranian hostage crisis. Soviet invasion of Afghanistan. Inflation was running hot. Then Paul Volcker raised interest rates to 21%. 21%! Gold collapsed to $300 by 1982. Then spent the next 17 years grinding lower, bottoming at $252 in August 1999. Total declined 70% over nearly 20 years. Gold didn't reclaim that $850 level until 2008, a 28-year wait. Now here's the critical context. This crash required the most aggressive monetary tightening in American history. It required central banks actively selling gold throughout the 1990s, and it required a strong US dollar backed by the world's unquestioned reserve currency status. Crash number 2, 2011 to 2015. Gold peaked at $1,917 in September 2011 during the debt ceiling crisis, then fell steadily for 4 years. The worst moment, April 2013. Gold dropped 25% in a single quarter, with half of that happening in just 2 days when Cyprus was forced to sell gold reserves and Goldman told clients to short it. The bottom hit $1,050 in December 2015. Total decline about 45% over 4.5 years. What caused it? The Fed's taper tantrum. The QE-driven inflation everyone expected never materialized. The dollar strengthened and the narrative flipped. Suddenly gold was dead. Credit Suisse literally declared it the end of the age of gold. Crash number 3, March 2020. The COVID crash. Gold dropped 12% in days, from $1,680 to $1,475. Margin calls forced liquidation everywhere. But here's the thing, gold hit a new all-time high of $2,072 within 5 months, fastest recovery in gold history. 3 crashes, 3 very different stories, and 3 very different recovery timelines. 28 years, 9 years, and 5 months. This is the million-dollar question, and I think the answer is clear when you look at the structural differences. Number one, central banks are buying, not selling. In the 1990s, central banks dumped gold aggressively. Today, they bought 863 tons last year. Poland is targeting 700 tons in reserves. China has bought for 15 straight months. 95% plan to buy more. This creates a structural demand floor that literally did not exist during either previous crash. Number two, there is no Volcker coming. In 1980, rates went from 21% to kill inflation. Today, US national debt is $38 trillion. Debt to GDP exceeds 130%. If you raise rates to 10%, let alone 20%, you trigger a sovereign debt crisis. The math doesn't allow it. Even the newly nominated Warsh is constrained by the debt burden. Number three, the dollar is weakening, not strengthening. Both the 1980 and 2011 crashes coincided with rising dollar strength. Today, the dollar index is at multi-year lows. The trend is down, not up. Number four, de-dollarization is real and accelerating. BRICS launched a digital settlement instrument last October. Over 90% of Russia-India-China trade now happens without dollars. Countries are actively building non-dollar payment infrastructure. This creates sustained structural demand for gold as the neutral alternative. Number five, the buyer base has diversified. The 1980 peak was driven by Western retail speculation. The 2011 peak was driven by Western ETF flows. Today's demand comes from central banks, Chinese institutional investors, Middle Eastern sovereign wealth funds, Indian households, and even stablecoin issuers like Tether buying physical gold. When demand comes from many sources, a single source collapse is far less likely. Does this mean gold can't correct? Absolutely not. We just watched a 21% correction. But a repeat of the 1980-style 70% crash or the 2011-style 45% multi-year decline, the conditions that created those events simply do not exist right now. Here's the part nobody wants to hear. Let's say you decided to wait in 2015. Gold was at $1,060. You said, I'll wait for it to drop back to $800. That drop never came. Gold went to $5,050. You missed a 377% return while waiting for a crash. Let's say you waited from mid-2024 when gold was $2,400. Same logic. It's too high. I'll wait for a pullback. Gold is now $5,050. You missed a 110% gain in 18 months. Here's a framework that might help. Think about your actual worry. Are you worried about a 10 to 15% correction? Those happen multiple times per year during bull markets. You can absolutely wait for one or simply dollar cost average through them. The January 2026 crash gave you a 21% discount, briefly. Are you worried about a 2011-style 45% multi-year crash? Ask yourself, do you see the Fed raising rates to 5, 6, 7%? Do you see central banks reversing course and selling gold? Do you see the dollar suddenly strengthening? If the answer to all three is a no, a 2011-style crash is unlikely. Are you worried about a 1980-style 70% crash? That requires 20% plus interest rates and a complete reversal of de-dollarization. With $38 trillion in debt, this is functionally impossible without triggering a sovereign crisis, which would probably send gold higher, not lower. The ugly truth? Most people who say they're waiting for a crash aren't waiting, they're frozen, and the cost of paralysis in a structural bull market is enormous. Fairness matters. Not everyone agrees this rally continues. The bear case. Analyst Avi Gilbert warned in January that gold appears to be entering its final act based on Elliott wave patterns. The World Gold Council's own bearish scenario sees a 5 to 20% correction if reflation succeeds and risk appetite returns. And after a 67% gain in 2025, some argue gold is simply borrowing returns from the future. The bull case. Every major bank targets higher prices. Goldman says $5,400. JPM says $6,300. UBS says $6,200 with upside to $7,200. Peter Schiff says 2026 is when it gets real for precious metals. Ray Dalio recommends 10 to 15% portfolio allocation and called gold the safest money in January. Jim Rickards projects $10,000. I'm not here to tell you who's right. I'm here to show you the data so you can decide for yourself. So, should you wait for a gold crash or buy now? The historical data shows gold crashes are rare. The severe ones require conditions, extreme rate hikes, central banks selling, dollar strength that don't currently exist. And the cost of waiting for a crash that doesn't come far exceeds the cost of buying at an imperfect price. If you're going to buy, consider dollar cost averaging over 3 to 6 months instead of going all in at one price. That way you naturally buy more if prices dip and less if they spike. It removes the need to time it perfectly. The one thing worse than buying at the wrong price is never buying at all and watching the structural factors. Debt, de-dollarization, central bank buying continue pushing gold higher without you. That's the research. Do your own due diligence. I'm not a financial advisor. If this was helpful, hit like and subscribe. I'm the Diversify Guy. See you in the next one.